Hello, welcome to the fourth podcast of ElysianNxt. I'm Chris, the CEO and founder of ElysianNxt. Recently, I've read a very interesting white paper that was released last week with a fascinating title, The Risk Function of the Future Now. It's a white paper that was co-authored by ElysianNxt and Avantage Reply. And today I'm joined with one of the authors of this white paper, with Piet Mandeville. He's the Director of Risk at ElysianNxt. Piet, welcome.
Thank you, Chris. Thank you.
So tell me, it's a very challenging topic, you know, the risk function of the future. Where did that idea originated?
Yeah, I agree that it's a very challenging and kind of promising title, The Risk Function of the Future. The idea originated on the back of a survey that our partner, Reply Avantage, did recently, their CRO survey, which surfaced quite some interesting insights into the pain points that are now on the top of the agenda for CROs in the financial industries, in the banks, etc. But Avantage Reply wanted to go further with that. They also wanted to create a content around that survey that goes beyond documentation of the observations, the findings of that survey, but also extract some practical and meaningful insights from there. So that's where the synergy between companies like Reply Avantage and ElysianNxt comes into play. Where we can then start discussing about these challenges that CROs face and how a technology company like ElysianNxt can help address these challenges, and how we can formulate a practical set of principles for the implementation of a future-proof risk function, let's call that. Mm-hmm. So in the end, we came to a number of insights that ultimately culminated in a call for action. To say, okay, based on these findings of the CRO survey and based on what is possible nowadays with technology and what is needed really by the changing world that financial institutions and banks operate in, what are the actions that can and should be taken from where we are now. Mm-hmm. So indeed, a very challenging topic, but a very urgent one to tackle, mm-hmm. in our opinion. Yeah.
Mm-hmm. I see. I mean, we've been around for quite some years. I've been around a bit longer than you are. But you know, what have you seen as kind of trends, evolutions within the risk function over the last 2 decades?
Yeah, good question. If we talk about the last 2 decades, I really would split that up in before global financial crisis, 2008 global financial crisis, and after, because that was really a breaking event, let's say, where the role of the risk function was basically redefined or started to be redefined based on the events that have unfolded, unfortunately, during the global financial crisis. Some of those were very obvious flaws in how the risk function was implemented at banks or financial institutions. Think, for example, about banks that, for in order to grow their business, their profitability, the ever-increasing demand for higher dividends, etc., there was so much pressure on banks to focus on that growth aspect of revenue profitability, that the risk function was basically, in many cases, a supporting function rather than a part of the overall strategizing process of the bank. Mm-hmm. And that is something that at the very highest level that you saw fundamentally changed with the global financial crisis. Why was it changed? Because what we saw is that a very good example of that ever increasing quest for more profitability was mortgage-backed securities, for example, where in the United States there was the whole business that was basically built to, on the short term, deliver more profit. But from a risk management perspective, it was not well understood, let alone managed. So that's situations that were basically obviously no longer sustainable. So after the global financial crisis, the focus came much more, and also the supervisors looked at the governance about risk governance in general, and how the risk function needs to be part of that strategizing process. And that's also one of the findings in the CRO survey, where basically, most of the companies that have weathered the global financial crisis better, and also nowadays, luckily, in most cases, we can actually say that the CROs are now, for example, reporting directly into the board, no longer into the CEO, because you can see where you need to have that decoupling to make sure that business strategy and risk management are basically aligned. So this is where you can see that there is a fundamental shift in focus on the overall role of the risk function, and that was triggered in the global financial crisis. But of course, it's not only global financial crisis, because over the last 2 decades, you also saw a tremendous change in the business environment at large, which I think we have boiled down to 4 main key external trends, which also have basically changed the way that the risk function operates. So you have the global financial crisis as the major, let's say, triggering event, and then you have key trends that also impact how the risk function in the future should be reimagined.
Okay. You mentioned 4 key trends. What are those 4 key trends?
We have boiled it down to, of course, the most obvious one when we talk about global financial crisis. As an immediate reaction, you see that the regulators are starting to scrutinize the banks, analyzing the flaws of the supervisory framework that allowed the GFC to happen in the first place, trying to address these gaps, and also focusing on the governance aspect of risk management. So you could see that shortly after the global financial crisis, there was already the first Basel III, shortly in the regulatory world, a number of years after the global financial crisis, there was already the Basel III framework that was implemented with a large focus on aspects of liquidity management that were a little bit underweight in the Basel II framework. Let's call it that way. But it doesn't stop the regulatory scrutiny does not stop in just merely plugging the gaps of what was missing. Like we said, it is also about the risk governance aspect, making sure that as part of that regulatory framework, there is also the governance that is implemented. There is also the requirements, for example, to have much more on-demand type of capability to say an event that triggers a crisis can happen any day. So where we used to be in a regime that for example, regulatory reporting was strictly done on a monthly interval, for example, now, based on that realization that an event can trigger a crisis any given day, also the demand on the risk function changes. You say, just a monthly process will not trigger, will not do anymore, will not suffice anymore. So I think that this is one very important trend, that is no longer just an incremental change on the regulation. It's the regulatory scrutiny really redefines the way that regulatory risk needs to be integrated with the overall risk management, and that risk function needs to be part of the overall governance framework. I think that this is one of the main things, but obviously over the last 2 decades, you also cannot look beyond the technology innovation. Well, if we compare the available technologies with 2 decades ago versus now, I mean, this is a completely different world we're talking about. What does that mean? Technologies have enabled completely new businesses to be surfacing, basically.
Yeah,
For example, there is a lot of online banking. There is a lot of financial services outside of the traditional banking. So technology has allowed the advent of a whole set of new competitive pressures, let's say. But at the same time, the same technology has also allowed risk functions to be much more accurate, to be much more agile, to be much more on demand. So I think you have the regulatory scrutiny as the first trend, the innovation and the technology, obviously, the second one. I would say the third one is the ever-increasing focus on costs. This is maybe less of a surprise. Focus on efficiencies and cost-cutting exercises are nothing new, but also because of that changing of the business environment, and because of that increased competitive environment, traditional banks, for example, are now under a much larger pressure to reduce their costs. And again, in the CRO survey, that surfaced very clearly that a large majority of the CROs was basically saying we consider ourselves as underfunded for the tasks at hand versus the capabilities that I need to build out for that versus the budget that is allocated to that. And that is also because of that technology. So that's basically, I would say, that the cost efficiency, the drive for efficiencies and cost reduction might be a trickle-down effect of the evolution and the technology evolution as the second trend. So that's the third one. And lastly, maybe, is something that has also is not captured in any of the previous 3 trends, but that is also changing the way that banks are doing business, is the expectation of the customers. I mean, the way, and again, that might be a consequence of the changing technologies and what is possible, but customers' expectations on how they interact with their financial service providers is fundamentally changed, which also means that risk functions need to be also addressing that new reality. So you can see that there's many evolutions. You can't capture it all into a short white paper, but we feel that these are the 4 main trends that affect the risk function in general.
Yeah, interesting. Yeah. I mean, also traditionally traditional revenue factor for banks was high interest rates. Last decade it was virtually zero. So exactly. that caused a problem in terms of profitability and need for cost efficiency exercises.
Exactly.
Now you mentioned that CROs they face challenges because they have to report faster, more detailed instead of typical month-end kind of exercises. Is there a bottleneck?
Is there a bottleneck? I would rephrase the question, where is the bottleneck? Or where are the bottlenecks? Because I would say that larger banks and banks that are traditionally serious about their risk management, they have embarked and they are embarking into a technology roadmap, a strategic technology roadmap. Why is that? Because what I mentioned now, where we are now in the demands on the risk function versus where we come from, is a fundamental shift in demands, which requires not just a plugging of current processes. It requires a rethinking of the whole process, the risk management process, the technologies that are required. And the older systems and processes, they often have a bottleneck because of the technological constraints. Again, legacy systems, for example, that are used currently in many cases are still just good enough to get the reports out on time, I would say. But in many cases, that is a lengthy process. Performance is sometimes slow on these aging technologies. Slow to the extent that it would not be feasible, and that's the first bottleneck, it would not be really feasible to say, okay, I'm going to use my existing legacy process and technology to try to comply with that new set of expectations from all stakeholders, including regulators. For example, ad hoc calculations of certain, for example, credit risk calculations, let's say an ECL calculation, multiple scenarios, everything is forward-looking, cash flow driven, massive amounts of data to be processed. And guess what, we need to now do that also as part of our overall risk management, not just at the end of the month. I need to do that under a number of scenarios because I need to anticipate what would be the impact on my credit losses under stress scenarios, for example. So that is definitely a bottleneck, a very practical one, to say if you are facing if you now have a process that runs for hours, is that really feasible? Is that future proof? Is that the process that will allow you to run that process ad hoc under any number of scenarios? In many cases, the answer that we see for banks that have gone through that exercise is basically no. We need to rethink. We need to make use of what is available in terms of latest technologies. We need to make sure that these processes are scalable. Batch processes tend to be less scalable. We all know that there will be an exponential growth on demands, on processing capacities, on number of scenarios and whatever. So that will not cease, that will not even cool down, that will only accelerate. Batch-driven processes, they can only take you so far. So the answer from a technology perspective there is if you work with the new concepts of microservices that are basically, let's say, specialized components, and your whole end-to-end process is built of these specialized components, and these are built with the latest streaming technologies, so that you can basically scale these up and run as many calculations, scenarios in parallel. So also using the cloud technologies to, for example, scale up your environment when you need heavy processing, scale it down when you don't need. All of that scaling, that flexibility, this is all something that would be definitely a bottleneck if you rely on all the technologies. So it's not only an enabler of meeting the future requirements, it's almost a necessity to have these capabilities.
So you see that new technology. You mentioned streaming, microservices, big data technology, of course cloud, which have thanks to COVID probably have revolutionized the industry. So you see that basically as the enabler to address the requirements of the risk functions as of now and probably also going into the future.
Well, it's not only this. There is a lot of challenges that need to be tackled overall, like from a governance perspective, from an operational perspective. But when we say that as part of the white paper, we try to distill some practical action points and basically define a call for action, that would be one of the most pressing ones, I would say. Because banks are not, this is not something that is quickly done. It is the rethinking of the technology roadmap, which is something that, if you look at the requirements and how they evolve and how they are anticipated to continue to evolve, these are exercises that if banks are not started these exercises now, they should start as soon as they can. Because for the moment there is a discrepancy between the speed at which these technologies are being adopted versus the expectation of stakeholders of these things being in place. So I think this is the call for action. Say, when we see from the CRO service where CROs have the main challenges versus what is possible with technologies nowadays, existing technologies, and what is expected from regulators, then the call for action is, guys, there is no couple of years to think about it. Need to take action immediately, because otherwise you will find yourself coming short of regulatory expectations.
Yeah. It's a clear call for action, Piet. Thank you for joining the podcast today and highlighting this fascinating topic of the risk function of the future.
My pleasure.
Thank you, viewers, for watching this episode, and I would say enjoy the reading of this very fascinating white paper. Thank you.